Hello and welcome everyone. My name is Gary Covert, and here we're going to be talking about how to evaluate opportunities in oil and gas. So let me jump in here and start to share my screen, but welcome everyone. And present. Okay. And here we go. Okay. So let's get to the beginning here. So my purpose today in doing this training is to help people evaluate oil and gas opportunities, because we are in the business of helping connect investors to oil and gas opportunities, drilling for oil, drilling for natural gas, getting involved in workover projects, all these sorts of things. And what we are often finding is that people don't understand what they're investing in, or hesitate because they don't understand. So we're always in the business of education on the opportunity. But today I wanted to dive in a little bit deeper and talk about how to evaluate the opportunities. So let's and this will be a little bit of a technical discussion. Again, disclaimers, we're not asking you to invest in anything. Nothing in here is a solicitation. Additionally, all the information here is for educational purposes only and not intended to replace the experience of professionals. So I've just found this is stuff that's worked for me and has been helpful for me and people that I've worked with. So having said that, so there are incredible opportunities in energy. So demand is increasing, prices are increasing. More and more people are looking for real assets that are inflation protected or even AI resistant. And energy really fits the bill. And that energy could be solar, it could be nuclear, it could be geothermal, it could be oil and gas. We're focusing on oil and gas at the moment. And we're going to be talking about ways that you can, really understand these opportunities a little bit better. Because the problem is, and this is a word that was shared with me with one of my potential investor partners, is that he said, Gary, as you know, the information is asymmetrical. You guys know a lot more about this than we do. And that's really what I'm really trying to overcome here and help people really understand how can you make good decisions in an area that appears to be highly technical and is often very opaque. People on one side of the equation tend to hold more of the cards than the other. And I want people to understand the technical issues, and I also want them to get beyond the marketing hype. There's a lot of, I believe, kind of, shiny brochures and smart marketing and all that sort of stuff. And I just want people to have some tools where they can make good rational thoughts. They've worked too hard to not take a good look at some of these things, and frankly apply some of the same kind of due diligence that they do. If you were asked to invest in real estate, you'd probably go look at a map, you'd probably go visit the property, look it up on Zillow at least. And that's kind of the level of what we're going to do here, is try to give you some of the tools that I found that are helpful so that you can really understand, the story that's being told to you, and so that you can do some more of your own due diligence and kind of balance the scales a little bit. This is a quote from Mark Twain. I think it's appropriate whether you're investing in a new tech stock or Bitcoin or any kind of stable coin or anything else, including gold mines and including oil and gas, but that a gold mine is a hole in the ground with a liar standing in front of it. And the idea is just avoid the hype and be smart about what you're investing in. There's obviously plenty of real gold mines out there, and people made a ton of money in gold and continue to do so. But we need to be able to separate the hype from the reality. Okay, so when an expert looks at oil and gas, they're looking at all sorts of technical data. And I'm going to use a little technical jargon here to make a point. They'll look at offset wells, they'll look at seismic maps, they'll look at well logs, they'll look at geology and petrophysics and all these sorts of things, all these different kind of color-coded maps and whatnot. And they are experts in it, and all this makes sense to them, and it may not to us. And that's the point is, and sometimes even when they're really trying to be helpful, sometimes technical people don't know how to separate and communicate clearly and just tell you what you need to know versus everything they know. They might be trying to be helpful and just like overshare. But the truth is, if they want to hide things, a technical person can, but most of them don't. What most of them are oversharing, are not able to kind of dumb down their technical information so that regular folks like you and I can understand what they're talking about. Plus, they have all this knowledge. Plus, they've got some very pricey software to help analyze all this stuff. So, there's a real disadvantage here. So I am not suggesting that anything I'm going to share with you today is going to replace any of that. And I'm not trying to suggest that, we're going to find a way to help you become a petroleum engineer or a reservoir geologist or any of that, but just help you kind of understand and make it kind of simple so that you can look at some of these opportunities and speak the same language. So appreciate you holding in with me through this preamble, but I totally guarantee that this is going to be worth it to you. So if you're very experienced in oil and gas, this is going to be so rudimentary to you. You're going to say this is probably kindergarten level stuff. And that's fine. It's not for you. This is really for the beginner, the person who, has a different kind of job. They're in real estate or they're an executive at a big company and they don't have time for a side hustle, but they're interested in being a smart investor and they're curious about energy. They're curious about oil and gas, and they just want to be a little bit smarter about how we do it. So if that's you, stick with us and we'll keep on going. So all this is kind of derived from a resource that I developed that I call the 15-minute scorecard. And for all the reasons I just described, I made a very simple scorecard to help people walk through and ask good questions about what's being put in front of them so that they really understand and can get beyond the marketing, get beyond the technical jargon to help them understand what they're looking at. So what I am going to do is focus on really these top three items here, and then also in the recap and everything else, I'll give you a link to this 15-minute scorecard so that you can go and ask good questions about all the rest of it. So we're going to be talking about how to gain confidence in the drilling location, how to get confidence in the quality of the well, how you can validate or compare apples to apples or oranges to oranges, and then introduce a concept that a lot of people don't even think about, which is the break-even price. So if we have time, we will go through some of these other ones at a high level, but primarily these three is what we're going to be talking about. So let's talk about the drilling location. So this is a real-world example. I was reading a trade publication, and they were talking about these new hot wells in Dawson County. So they called it the Dean Play, and you're talking about all these great wells that big famous operators are trying to drill and develop out there. And they named one of them. And so I thought that would be a good example for us to dive into. And the whole idea is just like if you were going to be investing in a property, you'd probably jump on Google Earth or you would jump on Zillow or something. You get a sense of where this thing is. And I want people to understand that there is good public information out there that you don't have to have an expensive subscription to gain access to and be able to get some basic information about the wells or the area that people are wanting to drill in. It will help you make much better decisions and ask much better questions. So in this case, this particular well was in Texas. And Texas, and I use these resources a lot. The Texas Railroad Commission GIS map has a lot of this information, so it's an interactive map. Plus, they also have databases, and I'll give you links to all this. They also have databases so that you can look up lease names and you can get down to production information. So that's actual data of how much oil, how much gas did a particular well actually produce. You can see it for yourself. I'm kind of like Reagan, trust but verify. I trust what people are telling me, but I'd like to see things for myself. And if that's for you, if that's the way you like to invest, and I suggest it's a good way, is trust and verify. This is a very good resource and process for you. So what I did is I took this lease name, the Overton B Unit number D2H, which they described as a Dean play in Dawson County, Texas. So I went and I just looked up the lease number from the lease name and on that site, and I was able to determine it's section 808-64300. So bear with me on this. There's a reason you get these numbers, and then you can look from that lease number. You can look up the well number, which in the state of Texas they call an API number. This is 115-34049. And with that information, I can then look it up on the map, see exactly where it is, and then I can also download the production history. Other states also have this. We're looking at projects in Oklahoma. I did the same process, looking for myself, in Oklahoma, and they've got very similar kind of resources for that as well. So let's see what kind of information you can get by doing just a quick little search like that. So I was able to find our well, this one in Dawson County, on a map. And this is not the interactive map, but if you were on the interactive map, you can zoom in, zoom out. And I've made some videos about that, which I think is fascinating. Just shows you how many wells are drilled out in Texas. But here, this little teal area right here, this is the well that we looked up. And a couple things. Now that you've seen it, a picture is worth 1,000 words. So now that you can see this well, this long line right here indicates that particular well. You can see it's got company. It's got company. It's got lots of different other wells around it. So if you're on this GIS map, you can click on all these other well names and get information about who is operating them, when were they drilled, have links to their production history, all that sort of good information. So that's one thing. You can see I've got lots of company in here. The other thing is now you get a sense of the scale of this well. People will often talk about, it's a 2-mile lateral or a 1-mile lateral or a 3-mile lateral. It means that they've drilled that distance, which is easy enough to imagine, but it's another thing to kind of see it in context with all these other things. So even without knowing that, I can look at this map, and each of these sections here is 1 mile. So I can see just visually, it's like this well here is about 1 mile, 2 miles, 2 miles and a bit, call it 2 miles and a third. So 2.3 miles, 2.5 miles, something like that. It's like, okay. And it's got a lot of company. So we know it's a fairly modern well. We know when it was drilled. It's drilled in May of 2025, which we'll get to here in a second. And then you can see that it's got lots of company around it. So just by doing that simple thing, it's almost like doing a Zillow search on a property. Somebody says, hey, you should look at this house. Well, first thing you probably do is go look on Zillow, see where it is and see what the comparables are. And this is the same thing you can do with publicly available information. So if you're doing this, you're ahead of, I think, 90% of the oil and gas investors. Just by doing this, you can ask some really good questions of your operator at this point. So the next thing is you can look up production history, and that's what I did. So utilizing the lease name, the lease number, I was able to look up this particular well, and I can see all the history from when it was drilled. And so it hasn't been drilled all that long. It came on production in May of 2025, and it's in current operation. You can see these last 3 lines, May, June, and July, don't have any reported information. Right now it's July 2nd. So there wouldn't be information for July, but it also is a good reminder that a lot of this production history comes in arrears. Usually like 90 days in arrears is when you start to get your production data. So pretty soon, maybe in the next couple of weeks, you'd see May up here. But until then, you can start to see all the production data in barrels of oil and in MCF. MCF means that's thousands of cubic feet. So that indicates how much gas is being produced. So you know, by looking at this production data, you know two things already. You know, it started in May of 2025 and it produces both oil and gas. So these are just production figures. And look at this nice little button down there. It says download. If you're an Excel kind of person, you can just click that little button and you'll get an Excel sheet. You can start to play around with it, do whatever kind of things you like, or you can just validate, you know, the information that's been given to you. So here you can see it came on in May, and then in June really hit its high point of 55,688 barrels. Oh, that's a lot of, that's over, I think I did the math earlier. It's like 12 or 1,300 barrels a day. It's pretty impressive. And then you can also see, and this is good to know, that it also declined. So it went from 55,000 barrels in a month to in April down to 12,623 barrels. So, you know, that's a good reminder that modern wells decline and they decline very quickly. But if you look at, you know, this particular well, I don't know how much it costs to drill it, but it's a 2.5 mile lateral. Let's say it costs 10 million or 13 million to drill. You could take this number and multiply it by some commodity price, say $50 or $60, and you say, well, how quick was it able to get its money back? You know, you can look at that. And then for a lot of people, and me included, you know, it was hard for me to wrap my head around what MCF was. You know, what's a volume of gas? It's just those in like kilowatts are like hard for me to think about. But anyway, MCF, if you want to convert that and just compare apples to apples, divide this number by 6. So divide 15,251 by 6. And that will give you an equivalent barrel oil, BOE, barrel oil equivalent that you can compare to an oil barrel. So just a little trick there. And then you can see they've got the list of the operator names. EOG Resources, a very famous operator. Laguna, Texas, in that area. Once you get on the interactive map, you would see that they're really operating a ton around there, which would be interesting. You know, if Laguna was asking you to invest with them, you know, you have a lot of information, a lot of things you can talk about now, because you say, I was on your map and I looked, I saw you drilled this and that, and what was your experience? So you're a much more informed investor, and you can have really good conversations with people. So there's two things you can do. You can look up production history, you can look it up on the map. And even, I would say, even if you just looked up on the map, you're way ahead of the game compared to a lot of investors. So a lot of good information in here and simple to get. Okay. Pardon me. So again, the 15-minute scorecard. So I'll give you a link to this, but this would be the first thing you'd want to, I encourage people when they go through this, is just score each of these on a scale of 1 to 10. 10 being highly confident, or maybe they've got more questions and so on and so forth and different things. So, you know, do you understand the drilling location? Do you like what's around it? Is it all alone? Is it the only thing out there? You know, that would give you some indication of you know, risk related to that. So next, let's talk about well quality. So what you noticed on that map was that those were mostly, the new wells are going to be horizontal wells. And many times I see people talking about like how many barrels you're ultimately going to get from a well. And that's called EUR, estimated ultimate recovery. A couple things to think about. One is an estimate. So a professional, but made that estimate, but it's still an estimate. You don't know how many actual barrels are going to be able to come out of a particular well. So it's an informed estimate. It's a professional estimate, but still an estimate. And one way so that you can compare apples to apples is taking that estimated ultimate recovery and dividing it by the horizontal drill length in feet. People will talk about, well, let's just go through two examples. So if somebody were to tell you, it's like, we have an estimated ultimate recovery, a reservoir engineer told us that we could say it has an EUR of 500,000 barrels and say, wow, that sounds great. You multiply that by 70 barrels, and you're like, wow, I'm rolling in money. It's $35 million. Yeah, you got to pay for it and a couple other things, but 500,000 barrels. And then you divide that by the lateral in feet. So roughly 5,200 feet in a mile. That will give you 96 barrels per foot. So this one well, you say, how long is it? They say it's 500,000. That's pretty high quality rock, as they say. So 96 barrels per foot. And then they might say, well, this other well is 750,000 EUR. Well, that's nice. Well, how long? How many frac stages do you need to do? So you can look at that. There's 2-mile lateral, 72 barrels per foot. Is that necessarily bad? No, but it's a little bit less than the other one. And you'd have to be asking questions like, so was there really a good economic benefit? Do you feel like it's a good economic benefit to spend the extra money to go an extra mile to get that other 250,000 barrels? So opens up some good questions on how oil men, and I'm not one of them. When I say oil men or oil man, oil woman, if you prefer, people that have really been in the business for a long time. I don't feel like I am one. I'm trying to educate myself into being one. But this is just how they do the math in their head. So is it worth it? Risk versus reward versus capital expense and all that sort of stuff. So this will help you think about well quality, drilling opportunity to drilling opportunity. Okay. So again, back to the scorecard, we talked about confidence in the drilling location. You can score that. Quality of the well, you can score that. And then confidence in the break-even price. I think this gets a little technical. You have to do a little bit of math on this, but I think it's worth it because it helps you understand the economics of an oil and gas well. Why you're going after it and how it's going to pay out. So, excuse me. We're talking about the break-even price. So the break-even price is the price of oil or gas, depending on the kinds of well you're going after. It might be a mix, like many of the Permian are like 80-20, liquid oil versus gas, and some, like we're looking at Oklahoma, those are 100% gas, do very little associated oil. But anyway, what's the break-even price of the commodity that you're trying to extract? Based on all the different factors. And this, to preface it again, this is just a very simple formula. You can get very, very complicated on this and add in some much deeper thinking and features like that I didn't include, like the cost of acquiring the lease and a number of other factors, time value of money. You didn't even talk about that. But at a very high level, this will help you. I think it's very powerful. So a break-even price, you get this by looking at your drilling and completing costs. How much does it cost to drill that well, divided by your EUR, which we just talked about on the previous slide, your estimated ultimate recovery, how many barrels do you think you're going to get, plus adding back in your operating expenses, because once you drill a well, you've just started. Now you have to have, for every barrel that you produce, you have to either run a pump or electricity, have a person go out there and get it, keep things maintained, so on and so forth. They call that operating expenses, divided by 1 minus royalty rate. So really this is, not to get technical, but your net revenue interest. It's like, how much are you actually going to be taking back from your investment? And you always have a silent partner in oil and gas, and that's going to be the person who owns the mineral rights. So in this case, let's just say the well cost $6 million and you had 550,000 barrels in EUR, and there's a 25% royalty, and it costs you $15 per barrel in your lifting costs or your production costs, then your break even is going to be that 6 million divided by $550,000 plus $15 divided by 0.75. And that will give you your break even price of $34 per barrel. So now what? What do you do with that information? Well, you look at that and you compare it to your thoughts about where the price of oil is going to be. Today it's around $70 or $80, based on fluctuations on the Straits of Hormuz and whatnot, but it's come down significantly since that opened up. But you have to look at, what you think the future price of oil is going to be, because this would be the minimum it needs to be over the entire life of the well for you to make your money back. So the question is, do you think that oil and gas or price of oil will be higher than 34, much higher than 34, close to 34? And that will give you an indicator of, how comfortable you are with this investment. So this is also a helpful way to think about it, because what would make the price of this break-even price move? Well, certainly if the drilling cost were higher, then your price per barrel would have to go up. If your EUR was higher, then it would go lower. So that's that. And then also it highlights the importance of that $15 sitting in there for your operating expenses. So if your operator is loosey-goosey and $100,000 here, $1 million there, on whatever, doesn't really have tight controls over their operating costs, then that flows through to you and affects your margin. So you want to make sure that they have good controls over there. And it's not sexy, but really important about your long-term operating costs. So if you can keep them around 15 or 10, get them down to 10, man, that makes a big difference on your profitability, but also the risk associated with the investment. So that's kind of how break-evens work, and I think something that a lot more people should think about. Many people don't, but a good way to think about it. And you could do this for gas as well. Just make sure you're comparing apples to apples. Okay, so the 15-minute scorecard, we talked about confidence of the drilling location. We talked about the quality of the well. That is so. Drilling location, go online, look at the actual well, find those where the offset wells or the wells that they say are just so good compared to where they expect to go drill, or if they want you to invest in a current well or a sister well, you should be able to dive in and go see exactly where that thing is. And then you can have a tool that you can look at the quality of the particular well in terms of EUR per foot compared to other opportunities. And then also we talked about the break-even price. So being able to calculate that, then you've got your economics hat on, and you can kind of look forward and say, this really makes sense in terms of how we can, make sense of whether this is a good long-term investment for us or not. Okay. A couple of these I'll just touch on at a high level. So one would be you want to look at the length of the payout period. So this is the time that it takes for you in cash to be able to recoup your investment from a dividend. And that this actually brings up an important point. That may not be the strategy. So if you have a 1 well, 2 well, 3 well kind of participation, then it's likely the idea is that all the dividends are going to come back to the investors, get them paid back, so on and so forth, and not reinvest. But sometimes you might have a situation where you've got maybe a 6 well or 7 well program, and the idea is just to keep those invested dollars inside the program so that it's self-sustaining into the future. And then, 4 or 5 years later, 3 or 4 years later, whatever, the program is self-sustaining. The cash flow from there helps you drill new wells, and everybody profits from that. So, long way of saying that, sometimes this applies and sometimes it doesn't, but that is a really good question to ask. Are we going to reinvest or not? But if you're not, then the payback period is how long it takes for you to recoup your initial investment in cash dividends back to you without looking at the tax ramifications. So payback period, if, let's say you put in $100,000 on investment and you're able to get that money back in 12 months, that's a really excellent time horizon. But typically they're between 12, 24, 3 years. Those are typically pretty good. If they're out in the 4 or 5, then that's a little bit more speculative. Is it really necessarily bad? I wouldn't say so, but it's going out there a little bit. So it's a little skinny on the deal. So I prefer to get my money back quickly. That's actually the liquidity factor. It's a simplistic way that Gary thinks about it, is that the quicker you get your money back, that's actually your exit. So you're already out, and later you can still get your 10, 12, 15% per year return, but you've got all your money back. So you can go invest in another oil and gas well or something else. So that's payback period. Confidence in operator quality. Within this scorecard, which you can download, I give you a lot more questions to ask, but even based on these 3 questions that we talked about, this drilling location, quality of the well, break-even price, all those kinds of factors, that will help you ask really good questions. And that's actually a really good time to help evaluate your operator or your sponsor, because the way that they're going to communicate with you tells you a lot. So most of them want to communicate with you in a really good manner. But if you're unclear or unsure or things don't add up, then that tells you a lot, in a short amount of time. So the quality of your questions and the quality of the responses can help you determine your operator quality. Revenue protection plan. I use that instead of saying hedging, because hedging is just one of these technical words and people think they know what it means and they may or may not. But what it just means is, did we lock in a price or not? And sometimes that's part of the strategy. Sometimes it's not, but it's definitely worth a question. And a lot of people don't understand to ask that question. And but it's definitely worth asking. If you're zero lock-in of price, you look like a genius when prices are going up, but it might be a little painful if prices go down. So it's pretty aggressive. But then on the flip side, if you lock in too much price and the price would go up and you're still stuck with a lower price, that doesn't feel good either. So, but anyway, it's good to know what I call a revenue protection plan is. And then last 2 points is clarity on the fee structure. So it costs a lot of time, energy, expertise to put an oil and gas deal together, to get the land, to get the permits, to know that that's a great place to do it, and to execute on everything. There really is a lot to it. So I don't begrudge fees to anybody, but you just need to know what they are and just make sure that you understand who's getting paid for what, and how the fee structure works, and just make sure you're getting treated fairly. Everybody should be getting treated fairly. Everybody in the deal should look at it and say, I'm so glad I'm here. We all made money and feel good about it. So the idea here is not to avoid fees, but just to make sure we understand them. And then the last point would be on well diversification. So you want to ask, is this just one deal that we're getting into, or is there many wells, and so on and so forth? So you just need to ask that question. And sometimes the answer is, yeah, we're just doing one well. Is that necessarily a bad thing? Maybe not, but there should be a good reason for it. Maybe a strategic reason. Sometimes it might be because we're going to drill a pilot well and get some good data before we invest further into the drilling program on the rest of the acreage, so that we know exactly what the best way to drill and frack and land and design our drilling plan and use our CapEx as effectively as possible. So there might be a very good reason to get into one well, but generally it's better to be in a couple different ones. Reduces the risk. So anyway, so those are some things that I think are really important for people to look at. Number one is just get educated so that you can ask better questions and don't risk getting mesmerized or overwhelmed by the fancy slides, the slick brochures, presentations, or the excuse me, or the technical jargon that is often tossed around. You don't just want to just sit there and just nod your head and go be afraid to ask a question. It should never be like that. So do a little bit of your own homework, and that will help you ask really good questions. Most sponsors and people that are in the business of helping, getting investors involved in programs would love to have really good conversations with people. They'd rather have the good conversations up front than try to explain things later people didn't understand. So I'm certainly in that camp. So I like to ask good questions. I like people asking me. If I don't know, we'll get another expert involved that will help out. So hope you found this to be helpful. So we're Southwest Alternatives. We help connect investors to opportunities that they would never otherwise be able to find on their own because of our industry connections and expertise. And we're really dedicated to help make these things accessible to people so that they understand what they're getting into. So we really love this education piece. So reach out if you had any questions about any of the resources that we talked about today. And if you have any interest in any of our programs or energy investing in general, just reach out. Our website is www.southwestalts.com. And my direct phone number is there and my direct email as well. But reach out to anyone on the team, reach out to me directly. That would be just fine. But anyway, sure appreciate all of you. Thank you for joining us, and we will talk soon.